But this is what happens with government intervention in these markets. It just distorts everything. People can afford things that they can't actually afford and get into just insane amounts of debt. The woke mortgage is coming whether you like it or not, and it's already started in the US. So let's dig right into this, see what's going on, kind of concerning. So mortgages for home buyers with good credit to cost more starting May 1st. High-risk buyers will pay less. Yes, you in fact heard that right. People with good credit are going to pay more than people with bad credit when it comes to getting their mortgage. And, you know, this is something that already goes on in Canada and in the United States, I believe, too, which we're going to go into a minute. This has already been happening and subsidized by the government, but now they're doing it with the fees that you pay on a mortgage when you originate that mortgage. So let's see what's going on here and see what they're saying. Under the rule, home buyers with a credit score of 680 or higher will reportedly have to pay about $40 a month more than people with worse credit when taking out a home loan. The rule goes into effect on May 1st, 2023, just ahead of the peak spring buying season. It will impact mortgages from private banks across the nation on loan level price adjustment LLPAs established by Fannie Mae and Freddie Mac. High credit consumers with scores ranging from 680 to above 780 will see a spike in mortgage costs, the New York Post reported, with the biggest increases being felt by those who put 15% to 20% down on a home. I mean, I know this is unbelievable almost that we are actually hearing about this, and people should be very, very worried and concerned about what's happening here, because it's not just this that is happening. We know that the G7 is bringing forward the central bank digital currency, and likely during this next crisis that will be an excuse to implement that central bank digital currency. And now we are seeing the woke nature of what is likely to happen when that central bank digital currency is implemented. The risk will be on the central bank instead of the banking system, so they can go and extend credit to people who might not be worthy of that credit, even at a lower rate, because it doesn't matter. The central bank can't go bust. I know that is just a worrying thought to even have, but this is actually happening. And a lot of people are probably saying, well, Luke, you've got your tinfoil hat on, central bank digital currency. But the reality is central bank digital currencies, they will likely be brought forward in the form that it won't make any difference, and it will be government benefits that will start being paid out using this central bank digital currency. And it will be slowly implemented into the system over the next decade.
Today, I'm proud to say that under the UK's presidency, the group of the world's 7 most advanced economies, the G7, is launching a set of public policy principles for retail central bank digital currencies, CBDCs. Central bank digital currencies could be a digital version of money, a bit like a digital banknote that could be used alongside physical notes and coins. Unlike most of the digital money people use daily today, it would be issued directly by a central bank, like the Bank of England in the UK. And governments and central banks across the world are working together, looking into what having a digital currency might mean in practice.
And it just leads open into the future the chance of a social credit scoring system coming to fruition, essentially. Because think about it, we saw that to a large extent in Canada anyway. During 2020 and 2021, there was a social credit scoring system, which basically was ranking you based on whether you had a medical choice. But in the future, it's likely going to be based on your carbon footprint. They're also talking about things similar to this at the World Economic Forum.
You mentioned, Julia, that currency is about trust for centuries, and it's about technological innovations for centuries also. Remember of the banknotes. None of us was alive 2 or 3 centuries ago, but it was a tremendous technological progress for central bank currency at that time. And in order to have the best of trust, which comes more from central bankers and the public side, and technological innovation, which comes more from the private sector, there is a part.
It's just very hard to watch, isn't it? And we just know what is coming down the pipe. And we know that they know that the central bank, people believe in that being an institution that is trustworthy. I mean, that's essentially what they were talking about there at the World Economic Forum. But central bank digital currencies, whether we like it or not, will become a reality. It's really just going to be a disaster for the future. nature in terms of freedom and liberty. But anyway, I want to show you this because this kind of proves the point that this has been going on in Canada anyways, and it's been going on in the US too. So in Canada, there are government-subsidized mortgages. So you have government-subsidized mortgages for people who are putting less than 20% down. Basically, they have CMHC insurance, which is a government entity that insures that mortgage. They say that it's to help provide more affordable housing, but in reality, we know what's going to happen when you have things that are going to essentially mean that more people can buy, whether it's because the government is sponsoring you or not. What's that going to do to prices, and what's that going to do to demand? It's going to obviously send it up. But what's really interesting is because if they default or they have to be foreclosed on, the CMHC essentially pays out for that. It's essentially insurance for that mortgage that we will pay out if that borrower defaults to allow the banks to lend. Because the reality is, if the banks, this insurance wasn't there, there wouldn't be any 5% down mortgage. You'd have to put a minimum of 20% down. But this is what happens with government intervention in these markets. It just distorts everything. People can afford things that they can't actually afford and get into just insane amounts of debt. But regardless about that, I want to show you how if you're actually putting more money down and you are taking on less risk, then you are in fact penalized for that. So if you look at this, a 5-year fixed mortgage, which is the most popular mortgage product here in Canada, is paying 5.54% right now, or 5.57% APR. So if you look at the 5-year fixed high ratio mortgage, so essentially the same product, but those people, it says right here, these rates are available to customers with less than 20% down payment on a purchase transaction and meeting other conditions. Okay, so they are able to get a mortgage that is literally over 50 basis points, over 0.5% less than the mortgage that the person is getting if they are putting more than 20% down. I mean, isn't that just completely backward when you think about it? Now, obviously, they have to pay CMHC mortgage insurance premiums and whatnot, but still, the risk for that borrower defaulting is just not being accounted for when it comes to these rates. So essentially, in a way, it just means that people are penalized who are taking on less risk than the people who are taking on more risk, because when it comes to the government, we'll lower those rates down. We'll have more relaxed lending standards when it comes to government insurance mortgages. And, you know, we're going to find this out the hard way, unfortunately, because when this all blows up, which it will blow up, then who's going to be feeling the pinch? Who is going to be paying for all these mortgages that are defaulted on and people that are foreclosed on? It will be the taxpayer. It's going to be you, and it's going to be me as well. So it's absolutely crazy. But this is also going on in the US because they have a similar system where the government subsidizes mortgages where people are putting less than 20% down. So the reality is this is already kind of happening. In the US, what's happening now is they're just taking even more measures, essentially, for the borrower that is higher risk. And I can't believe it. It's just absolutely baffling. And for us, for people who have good credit, for people who have saved up the money for a down payment, it's just like a slap in the face, essentially. It really is. The banks couldn't be more happy to lend to somebody with a government-insured mortgage. They don't really care about that. But when it comes to a mortgage that's actually going to be on their books, oh yeah, they start to worry about that a little bit more. What people don't talk about when it comes to the CMHC insurance and when this all blows up, which it will blow up, is when the housing market and people really start to default and the shit really starts to hit the fan, essentially. You're obviously going to see the government that's going to come out and say, hey guys, we can't cover all these losses. So you're going to have to take a lot of these losses too. And then that will be the CMHC mortgage insurance will be done. It will be done then, because once they invalidate it by doing something like that, it doesn't matter if it continues after that. It won't be treated as it's treated right now, which is lower risk, essentially, for the banks, which is just, it's unbelievable. It's subprime, essentially. People putting less than 20% down, they're subprime. It's just we don't use these words anymore because people think 2008, and they rightly should think that. So anyway, I want to thank you for watching this video, this live stream. If you've enjoyed it, you might like either of these videos here. Thank you so much, and I will see you in the next one. Take care, guys. Bye-bye.